very soon.
Recording in progress.
Let's wait a few minutes for others to join. We'll be starting very soon. Thank you. Once again, thank you for joining us on this webinar. We'll be starting in 2 minutes time. Thank you. I don't think so. Good afternoon, ladies and gentlemen. Welcome to today's webinar on managing problem loans, root causes and needed changes. Today is one of the finest days that we can think of in addressing a persistent problem that has been with us in the financial sector. My name is Yao Jemfi. I'm the Executive Director for GAMFIN. And today's webinar is the first of the webinars in 4-part series on managing problem loans. Today's discussion is on the current state in the industry and understanding the root cause and the impact it has on micro and small businesses, which is the foundation of our economy. Today's webinar is hosted by GAMFIN and CAPLAS through the partnership with MasterCard Foundation to strengthen Ghana's non-banks financial sector. The program is called FIRST Plus, which stands for Financial Institutions, Resilience and Strengthening. FIRST Plus addresses the challenges across the industry through webinars like this, workshops, and training sessions. CAPLAS also provide one-on-one technical assistance to financially solid institutions that are committed to scaling up MSME financing. Now, at the end of the day, we will provide contact information if you would like to learn more. Today with me on the team is a panel of 3 distinguished gentlemen who have seen it through and through and want to share part of the experience with us. I have with me Zibrim Bozima, who has over 15 years experience in banking, both in Ghana and outside, as well as providing consulting services in credit risk management, credit restructuring, credit portfolio management, and arrears and loan recovery management.
Hi, everyone.
Please. So that is Zibrim on your screen. The next person is Mr. Trinboa Kodia, TK for short. TK is the Executive Secretary for the Ghana Association of Savings and Loan Companies. He's in credit risk management, internal controls, and investment. He's been training a lot of people in credit risk management lately. TK, can we see you?
Hello. Good afternoon, everyone.
Thank you, TK. Our next person is another distinguished gentleman by name Mawina Kofi Abba. Mawina is a rural and agricultural finance expert in agronomy, financial inclusion, MSME, and agricultural finance, working in Ghana for more than 12 years. He previously worked with ProCredit, Savings and Loans, Fidelity Bank, Advanced Savings and Loans, and currently work with IPC.
Okay, thank you very much, Yao. Your mic is currently muted, so I didn't hear the last part of what you said. But I currently work with IPC, which is a German financial sector consulting firm. Thank you very much, and I'm happy to be part of this panel. Thank you. Back to you, Yao.
Thank you, Mauna. Thank you for prompting me. So with this team, today we have a lot to discuss at our hands. But I think before the team comes in, let me share a few information that we've gathered from the Bank of Ghana on our subsector. And this one in particular is just reference to the microfinance sector. We are looking at microcredit and then microfinance companies information for this purpose. Now let's pick some few things on our asset trend since 2017. But the asset trend started well and declined from 2017 till 2018, 2019, where we had a banking license or banking sector cleanup. And then it has started picking up till today. And today, it looks like getting back to the normal days, where asset was around 1.1 billion. On liabilities and shareholders fund from 2017 till 2021, it's just also reflect the same trend as we saw with the asset. Started well with 1.1 to 1.2 decline, and then declined sharply during the revocation of license period, and then has started picking up after the exercise. Then we have assets of the top 10 institutions in the system. These top 10 institutions, if you look at their performance so far, on asset level, for 2020, it was 52.66, and then 2021, it moved up to 58.05. On deposits, it's 67%. And then for the same period, for 2020 and 2021, was 67%. Credit in 2020 was 62%. And then in 2021, it moved up to 67%. And investment is 57.8% for 2020, and then it has moved up to 60.23. This tells you that the top 10 institutions are occupying more than 55% of our portfolio in all directions. And we believe that the others need to back up to move the sector quickly up. In terms of our capital adequacy and the non-performing loans, the blue line represents the capital adequacy ratio, and then the non-performing loans are represented by the red lines. And if you look at the trend, the capital adequacy reduced a bit in 2018, and then it starts soaring up during the 2019, and gradually it's just coming down. Now, in terms of NPL, it has not gone down so much. Relatively, it has been more consistent and persistent. And today, what we've seen is that it's just declining a bit. And we know over time it should come down to a acceptable range. If you look at our profitability ratios, return on equity, return on assets, and return on earning assets, the return on earning asset and return on assets are moving in tandem. And what we've realized is that they move together because each one affects the other. And so in the microfinance sector, basically our assets are the loans book and then the investment that we have. And these things are moving rightly in tandem. And what we've seen is that there has been some negative recordings that have made over the period. And we need to work out how we can move away from it. In terms of return on equity, it has been fluctuating. The figures has been negative for some time, it move up, and then it has started declining once again. Now, all these things inform us that a lot of the work has to be
I'm sorry, Yao, you somehow is on mute again.
I think he's having challenges with his internet. Maybe if you can project the screen whilst we wait for him.
Hello,
Why don't-
Mona.
Oh, you're back. Okay. I was just
Yes.
gonna invite them to answer the first question.
Yeah. I think just as I said before I went off, if I can hear from your perspective, does the data reflect on what is on the ground? And I will start with Mauna.
Okay. Sure, my mic is on. Okay, thank you very much, Yao. So as the data shows, as we've seen over the period, that there has been some stagnation in terms of development in PAR. PAR has, at least for the microfinance segment, has been slightly reducing over the period. In the banking sector in general, however, this has not been the case. It's been actually worsening. However, the portfolio has been growing in the general sector, in the banking sector in general. What we've seen as the reasons behind the trend, especially for the microfinance segment, is one, there has been some write-offs as a result of challenges experienced in the follow-up to the cleanup. And then there has also been some small recoveries, but then there's also been a lot of write-offs, as I indicated when we moved away from the cleanup from the cleanup exercise. Then what other thing happens is the fact that the portfolios have not gotten back to where it used to be prior to the cleanup. Portfolio development has been a bit slow after the cleanup. So you realize when it comes to NPLs, the percentage changes is quite slow. So the percentage of NPL as in relation to the portfolio is small, but then you realize because the portfolio is not growing, you realize that the NPL is also showing very, very small trends.
Thank you, Mauna. Can we hear from Zibrim?
All right. Good afternoon, everyone. Thank you very much, Yao. So in addition to what Mawana said, actually, the data actually reflects what is on the ground. And if you look at the data, basically, you would have realized that one, the NPLs of the microfinance sector seem to be going down. Data is very important. The graph is good, but we need to understand why is that curve going down. The reason why we realize that NPL is going down is not necessarily because the microfinance institutions are doing well. What is happening is that now Bank of Ghana is quite strict on the microfinance or the banking sector. So when the loan facilities are due for write-off, you need to write it off. And when you write off down, it makes your curve look a bit better as though you are doing well. But in reality, you are actually not doing well. The other part of the issue is the fact that one, we also realize that the banks have to do a lot of provisioning in terms of the loans they disburse. So if you go to the other slides you have projected, we would have realized that in terms of profitability or the earnings, the banking or the microfinance sector is not doing well. One is the fact that you do a lot of write-off. When you write off, you don't earn the money immediately until you recover. So in that case, you don't get that part. Two is the provisioning. Most of our loans in that microfinance institutions or the real banking sector have a lot of high provisioning. And when you do higher provisioning on your loans, at the end of the day, it comes to knock off your profitability. So you realize that they're not making profits. The other part is that after the COVID, most of the financial institutions currently are doing restructuring. And if you do more restructuring, it means you need to give a higher or a more tenor for the client to be able to pay. And then the higher the tenor or the restructuring, when you do, you add back the interest component and then the penalties that you charge. So eventually it increases your provisioning rate. So all these factors go on to knock off your profitability. So at the end of the day, the sector doesn't look a bit profitable, but that is not the end of the story. There's a lot we can do to ensure that the microfinance sector bounce back and then to be able to help the SMEs to also grow.
Thank you very much. That's not the end of the story. Chike, what's your take on that?
Thank you very much. And if you look at what Zibrim and Mauna have said, that is it. If you look at the balance sheets from 2017 to 2021, you will realize that one contributory factor is MFIs are moving away from granting loans. The same thing is happening in the commercial banking sector, that they are moving away from granting more loans because our business is granting of loans. And that is where our biggest revenue will come from. So if financial institutions, and for that matter, credit-giving institutions are not granting loans, then how will they be more profitable? And another thing that you can also see is that once your loan book to your balance sheet is not growing as much, then you will see a drop in your NPL. Another observation that I also made was the fact that if you look at the top 10 institutions, which takes about 56%, when you go to the savings and loan sector, the top 10 actually take about 80% of the total assets. And so it tells us the size of the financial institutions and what these big players are doing. If the big players are not doing what is required in the sector, then the whole sector is going to face that challenge. Thank you very much.
Thank you, Chike. So, Chike, back to you. In the wake of all these things, how do you see the impact to create on the MSMEs?
Okay, thank you very much. The first thing is that, which we have already seen, is that credit to the sectors that need to grow the economy is going down. One, these sectors are not getting the right support in terms of policy direction. Number two, the financial institutions are becoming more good at risk management. And the more you become interested in managing the risk, then you have to be very careful the kind of sectors you also disburse funds into. For instance, if you look at the sectorial breakdown of the sector where our loans go to, you will realize that services is getting more. But services is not the sector that develops the economy ultimately. Another thing has to do with our approach to governance. So these are some of the things that we need to pay attention to and look at.
Thank you very much. Ziblim, can you comment on that same question for me?
Okay, so in terms of impact, it's two-way affair. It has an impact on the financial institution. It also has an impact on the SMEs. One, especially when we come to the microfinance institutions, one key area that we get our profit from is the loan books. So if you look at the graph you are seeing right now, loan alone is about 49%. So that tells you that a higher margin in terms of your profitability will come from this sector. So if you don't give out the loans, then of course, then the 49% will gradually decline and go to maybe 20 or 30 or 10%. And the same will apply to your profit level. Now, if you are able to also give out the loan, of course, then it increases your profit margin. Now, the issue has to do with the impact on the SME. We all know the role SME plays in our economy. It's basically the engine of growth. That is where it employs a chunk of our population. So if the financial institutions are running out from these SMEs, then obviously the SMEs are going to die off or they are going to reduce. And if they reduce, definitely it's going to impact on the economy. So if you don't want the economy to go down, then we need to support the SMEs. Secondly, we all know that the SMEs also are the largest or the very big institution that employs a lot of the youth, be it the women and then the youth coming out of the universities. And if these SMEs are not able to survive, then of course, the next thing that is going to happen is that we'll have job losses. And when you have job losses, we all know the ripple effect of job losses. There's going to be agitations, there's going to be an increase in crime rates, and a whole lot. So the impact is not that easy if you don't support the SME. The third part is that if we don't also support the SME, of course, most of these SMEs have a lot of loans on their head, either a formal loan or informal loans. If these sectors are not properly supported, then what is going to happen is that they are not able to repay back the loans they took from the financial institutions. And that also have an impact on the financial institution and to the large extent to the country. So one, we are looking at job losses. Two, we are looking at the impact of their losses to employment. And three, we are looking at the whole sector going off into something else we are not ready to absorb. So these are the three areas that may be impacted if we don't support the SME.
Thank you. Can we have comment quickly from Maone?
Yeah, so my two panelists have said most of what is going to be the impact on the MSME sector. So all I will have to add will be that once this financing, once they are starved of financing, what it means is they will be forced to look for alternative sources of financing, which are mostly in private money lenders, which are quite expensive. And if they need to combine the payment of financing from the formal financial institutions and also these private money lenders, it will put some pressure on their ability to repay, which would then further lead to deteriorating of portfolios because they'll be struggling to pay two installments at the same time. So it means the NPLs will go higher, and then that will also demotivate financial institutions from on-lending further funds to this sector. So it will become a vicious cycle. So it's important to address it now rather than allow it to multiply going forward. Thank you.
Thank you. Zebulon, I think back to you. I want to find out from you, from your engagement with a number of institutions and industry, what do you think are the root causes of all these problems that we are having?
Right. Thank you very much, Yao. Obviously, the financial institutions have the capacity, but they do not know even if they have the capacity or not. They have the capacity to be able to manage some of these excesses. One of the reasons why the financial institutions are not ready to go into this lending is that the staff who are the loan officers or the credit officers or the credit analysts don't have the needed skills or the required skills to be able to do a proper appraisal of some of these SMEs. The SMEs are not risky environment. They are not risky businesses, but we perceive them to be because they don't basically keep records or they are not too organized. But if you have a technical know-how of the kind of business they do, if you really drill down into the nature of their business, the scenarios of the business, what they do, and you have a perfect understanding, this is not a loan that when you disburse, you go bad. So the financial institutions are not ready to go there because they don't have some of this expertise, or they don't take their time to understand the nature of the SME they are financing. That's one area we need to look at. That's the reason why we have some of this NPL. The second part is that we have already disbursed bad loans in most of these financial institutions. So the banks are looking at the portfolio and say, okay, the SME is giving me a higher NPL. So why do I want to venture into it? So they kind of shy away from these SMEs. But the reality is that if the loan officers are given the needed training in terms of credit appraisal, especially qualitative, if they are able to do proper qualitative, because the SME, when you use quantitative financials, you might be disbursing the wrong loans. But the qualitative aspect of it, if they have that skills to be able to appraise the facility, of course, then we will not be shying away from them. The other part is also about the COVID impact that came up. You know, some of these sectors actually shocked, like they absorb a bigger shock of the impact of the COVID. So the businesses are not doing well, repayment are not going well. And it's already another indicator to the banks that these are areas that we should not venture in. And you realize that the banks are not actually even lending. Most banks currently are looking at restructuring and then keeping their money in investment. So these three areas, we need to look at it as the reason why the NPL is going bad, but there's always a solution to this NPL. We can manage it. Thank you so much.
Thank you. Can we hear from TK?
Thank you very much. To add to what my colleague said, another key thing is the fact that institutions are trying to manage their risk better. And so, just as my colleague said, once they know a particular sector is a source of their challenges, they will want to shy away from that place. But we should be mindful of the purpose for our existence as businesses. The next thing is the poor credit culture that we have in our institutions. The next one is our legal system has not been very supportive over the years. Now we have the new Borrowers and Lenders Act, which gives more power to the client and also tells the financial institutions what can be done, what cannot be done. This is another area that most people are shying away from. Another thing has to do with the underwriting skill. Most of us are not using the right analytical tools, and therefore the loans get bad from the word start. Again, we do not also have patience funds. We are relying on short-term fixed deposits to grant loans, and loans to businesses or SMEs. You need patient funds such that you can give to that business 2 years, 3 years. But the real businesses cannot get these funds. And therefore, when they go to borrow within 3 months, 6 months, 1 year, they have to pay. What work can they do with the money? So if we're able to address some of these things, especially the legal framework and the regulatory systems and all those things, I'm sure we'll be able to serve the SME market better. Thank you.
Thank you, TK. Any addition from Mauna?
Yes, yeah. So what I'll add as the other root causes for where we see ourselves today is one, inadequate monitoring of our loans. Now, once the loans are disbursed, in many cases, people don't follow up anymore to see whether what has been planned to be done is actually done or not. That's the investment plan. You know, the purpose of the loan is to invest into something which would cause a growth in profitability or a growth in sales, which we then use to make payment for the loan. So if this is not carried out or is not carried out on time, this will have an impact on the ability of the business to repay. So that's one key thing that is one of the reasons why we are where we are. Another one is about delays in disbursement. So some of the investment plans, they have specific times by which they must be carried out. So if the loan doesn't come early enough to meet this plan, what it means is when the money comes and the thing is even done, it may not be able to achieve its needed impact. For example, if, in the case of planting, if let's say somebody is taking a loan for farming, he needs money to buy seeds in a particular month. If the money comes later than that month, it means the plant is going to suffer. So it's important to also do disbursements according to the needs of the customer. One thing also related to what TK already said has to do with the credit underwriting. So I'll look at both over-financing and then under-financing. In many cases, you realize customers come and apply for loan amounts bigger than what they actually need, knowing that in many cases, financial institutions will reduce the amount they apply for. So they come and apply for a bigger amount. Once this is not properly analyzed and the officer goes ahead to give this amount, the business is not able to utilize the amount properly. In many cases, they may want to use it to do another kind of business so they can generate income up to their main income to make payments. And it often fails. For underfinancing, in this case, what it means is sometimes the investment plan is not properly analyzed. So money that the customer needs, for example, if the customer needs money for an equipment to be installed in a factory, and the analysis is not properly done, the officer may be able to finance the cost of the equipment, but the cost of clearing it, the cost of installation, the cost of installing maybe a 3-phase at the factory may not have been factored in the analysis. So what it means is the investment will not be carried out, which would affect the subsequent ability of the customer to pay. So these are some other of the reasons why we are where we are today. Thank you.
Thank you very much. Before we go on, those on the call today, please be reminded that you will have a session to ask all your questions. So if you can note your questions down for us, that would be very useful. Thank you. So Mauna, back to you. In all this, what can the financial institutions do differently?
Okay, so what they can do differently, I would put them in 2 categories. One will have to do with the personnel, and then the second would have to do with policies that they need to put in place. So starting from personnel, what should they do? One, the recruitment and training approach has to change. In the earlier discussions, Ibrahim talked about capacity of officers. It is important to recruit people who can understand and do the business. Not to say that people without accounting background should not be recruited as credit officers, but this means if you are recruiting people who don't have the necessary background, it is important as an institution to train these people to get the capacity to do this. Another example could be recruiting people to do, let's say, agricultural financing. it is also important to recruit people who have an understanding of Agric and then train them with accounting principles to be able to analyze and then disburse loans to the agricultural sector appropriately. If possible, it's also necessary to have specialized officers for different categories of loans. You can have specialized officers be responsible for agri sector. You can have officers responsible for the smaller segment of customers, officers responsible for maybe the medium-sized businesses, and then officers responsible for the larger businesses, so that they can properly understand these segments to be able to finance them appropriately. When it comes to policies, I will just talk about one of the things so I don't take everything from my colleague panelists. One thing they can do is to make certain practices mandatory, like make it mandatory for all officers to monitor the investments that have been applied for. So once the loan is taken for a particular purpose, it should be mandatory that the timelines are followed up to make sure that these things have actually been done, so that the projections that were made based on it can be achieved. So I'll leave it here for colleagues to also continue. Thank you.
Can we go to Ziblim?
Yes, yeah. Thank you very much, Marina. I'm going to look at it from two folds. One has to do with what will come in, and then the other side has to do what is there already. Currently, you have loan portfolios which are bad, okay, and you really have to manage it some way somehow. The other part has to do with what is also coming into the new to add up to the existing portfolio. What do we do? First, in terms of what is coming into the portfolio, I'll still mention capacity building. What do I mean by capacity building? So going forward, all the financial institutions have to teach their credit officers, in fact, the entire credit lending cycle, right from the client acquisition up to the end of the loan, and then probably recovery. In this client capacity building or staff capacity building, one, the financial institution need to teach their credit officers how to interview even clients. What kind of information do they need? What kind of data do they need? What is the understanding of the business? That is the interviewing skills. Every credit officer must go through this. Two, the credit officers must go through financial analysis, both qualitative and quantitative, to ensure that almost everything they are analyzing, they have a deeper understanding, a good knowledge of the business, and then the financing part of the business. All right. Then the credit committees or the loan approving authorities also must be enhanced. It's not only the credit officers. The COVID-related pandemic has taught us a lot of lessons. So what you sit in the credit committee to make a decision today, it has changed. So both the credit officers and then the approving authority need some level of capacity building to be able to understand the new dynamics, the future problems that may occur, or anything in terms of loan approval and then loan appraiser. The other part is what is existing. The existing loans which are bad, what do we do? Financial institutions have to also take a second look at their portfolio. One, they need to look at their credit policy. What have they done wrong in the past that created this problem today? Because some of the policies don't give enough room for them to even be able to manage the loans they have in their books. So review your credit policy, know the goods and the bad side of the policy, come up with appropriate solution that will enhance your portfolio quality. That's the first part. Two, almost all the loans in the portfolio, we need to develop a very proactive monitoring scheme to be able to understand what the challenges are in the business and what we can do to help or to assist to ensure that this client or the facilities are performing and directly give good account of the bank. The final one has to do with a lot of restructuring. Right now, we have the loans which are bad. We are not ready to give them more money. The client or the businesses are struggling. And if you watch them to continue, it will get to a point, payment fatigue will set in. They don't have the capacity to pay you and all that. So it's going to cause trouble for you. What you can do is to do a holistic restructuring by doing portfolio analysis to know which area do you need to restructure, which area do you need to refinance, and going forward what you have to do. So these are the two approaches for now I think the banks have to do to be able to manage the situation. Thank you.
Thank you very much. TK, any additions?
Thank you very much. And thank you, my earlier speakers, Zebrim and Mawuna. Financial institutions need to make sure that we comply with regulations. If you look at the reasons for the various licenses revoked and the report from the central bank, you will realize that most of the institutions did not comply with regulations. There's a single obligor. If you have a negative CAR, you do not continue to grant loans and all these things. The next thing is we should look at using analytical tools, because the customer of today has become more sophisticated. They are more clever. And the moment they decide to come and take a loan, they have thought of how to default. So let us see every customer as a potential defaulter, even if this is the 10th cycle of the person. The next thing I want to talk about has to do with, we need to take time to understand our customers. Most often you will see a one size fits all. We need to appreciate the differences in our various customers. Let's spend time to research into our customers. And then reporting. And then the use of collateral. If you use collateral, you need to make sure you perfect it and perfect it well. The Borrowers and Lenders Act gives us how that can be done. There are a lot of institutions that I've come across. Some have gone off, some are still existing and struggling, and their loan book continues to deteriorate because they cannot realize their collateral. You go to the courts and the court takes your contract, the loan contract, and it's bad. Please, let's get right technical support to develop the right loan contract that protects the customer, at the same time protect the financial institution. If it is a one way, then the court may not be in your favor. The last thing I want to talk about has to do with our lending methodology. Let us review our lending methodologies. If what we are doing has not been helpful, let's get the right method so that we get the best out of it. Thank you very much.
Thank you very much. Let's get the right method. I think at this point, Mauna, I want to come back to you. I want to find out from you, how can we ensure that we extend minimal impact in all this to the MSMEs?
Okay, thank you very much, Yao. I think I would want to continue from where TK left off. I think the word understand should be written in gold. It is important for the financial institutions to properly understand the business model of their customers. You need to understand who are they buying from, who are they selling to, because these linkages are the most important parts of the business. If we know the things happening at the side of the places they are buying from, and we know what is happening ahead of them, that is where they are selling to, it will help us to understand what could happen in the business that we are analyzing. It is important to understand the terms of sales. Is the customer selling on credit? Is he selling in cash? And also the terms of purchases. Are they buying on credit? Are they buying in cash, on cash basis? This all helps us in properly analyzing and structuring our financing to these customers. Then another thing I will talk about is it is important for us to also start having SME clinics as part of our CSR activities. You know, we shouldn't always have to go to do cleanups at markets or do donations. Let us also use this opportunity to engage customers, both those that are in our portfolios and then those that are not in the portfolio. Let's try to let them understand what we do as financial institutions and how we can help them. it was also an opportunity for us to find out what they need and how we can help them. Learnings that we can get from such events can help us even develop products that properly meet their needs as institutions. Finally, what I also say is that it is not always the case that the business needs a loan. There are times when maybe all they need is a guarantee so that they can get maybe a supplier's credit. Sometimes they will just need a credit line or a letter of credit. So let's try to look at products holistically. What exactly is the business looking for? Or what exactly is needed by the business at this time? So we can give them appropriate financial instruments to be able to conduct their businesses. So I'll end it here. Thank you.
Thank you very much. Yes, Zibim.
All right. The question actually is, what do we do to be able to assist, correct?
Okay, thank you.
Oh.
Zibim, I think we'll move to the next question.
Okay.
What do financial institutions need to do to prevent high NPLs in the future?
All right. Like we said earlier, I mean, most of these financial institutions can be able to manage. The first part has to do with what they have now. Like I said earlier on, we need to do a very quick portfolio review, okay, of the existing portfolio to ensure that we understand the dynamics of our own portfolio, which area is giving us trouble and which area is performing. Then we'll be able to adopt or come up with good strategy to be able to manage that sector. And we'll have to look at areas that we can also go in directly to help the client in terms of understanding what the issues are and how best we can partner each other. That is the financial institution and then the client to be able to continue with the repayments. The initial part also I've mentioned earlier was the fact that the screening of the loan, all right? If we are able to do a good job from the start, because we have this common saying, garbage in, garbage out. If we don't do a proper analysis, we don't do proper screening, we don't understand the nature of the client, we don't even understand the business needs of the client, and we just give our loans because we just want to grow the portfolio, then what is going to happen is that in the future, you have the bad portfolio to manage. But if you understand the need of the client, you understand the nature of the client, and then you really can tailor in a product that can suit the client. What we do mostly is that is one, whatever fits everybody. So every client that comes in, all we interested is, what do you want? You want money, how much? Use it for what? And then the client will tell you working capital. Working capital is not good enough for you. You take it up, you go to committee, you get approval. Apparently, it is not a working capital because you don't even understand the need of the client. And you give out this money, diversion comes in, the person uses the money for other products rather than the business is doing. So at the screening stage, we need to really understand, what does the client want? Most of these SMEs only run into the bank because they see their friends going for money. And they also run into you that I want money to grow my business. So if shop A or a client in shop A realize that shop B stock is growing big, the tendency for client A to run to the bank and just come and compete in growing the stock is very high. Meanwhile, this client might not be even needing any stock. He has a stock pile up already. He's not been able to sell. Meanwhile, he comes to the loan officer and say, I want stock, and we give the money. Now you give the money, he buys the stock, he go and put it in, and it's not a moving stock. What happens? He doesn't have the money to pay you again. But you need to understand, does this person really need the stock? Or he needs just a small working capital to turn around the business? So understanding the business, understanding the need of the business, understanding the loan purpose is one key area the financial institution need to pay attention on. And when we come to the committee or when the credit officer submits the proposal for approval, we need to ask the relevant question, look at the risk, and then the mitigation factors in the area before we lend the money. Thank you so much.
Thank you very much. Chige, any quick addition on this?
Thank you very much. I always have these 6 questions if you'll be able to reduce your NPL. 1, ask yourself, who is that client? And how well do I know this client? Number 2, do I really have a contract with this person? And what does the contract say? A bad contract, you will not be able to enforce it. The third one, does the customer really understand the contract that I've entered into? And does he really appreciate the implications? The fourth question you want to ask yourself as to whether the customer has the capacity to pay the facility. The next thing is the customer willing, in line with the contract, to pay according to what you have agreed with? There are a lot of tools, there are a lot of strategies available that you'll be able to do this. And the last one, what are we doing as an institution to assure ourselves that throughout the loan repayment period, the customer is able and willing to pay in line with the contract that we have entered into it? In addition to all that we have said today, if we put them into good use, we'll be able to manage our NPL very well. Thank you.
So TK, what will be your final few words to our participants? What should they remember for today?
Thank you very much. We are into this business of lending, and credit is the highest source of revenue for any microfinance institution. The next thing is that let's take the right approaches, comply with regulations, pay attention to the figures, periodic monitoring and performance appraisal, and we will be there. Thank you very much.
Thank you. Mauna, what should be their take-home word?
Okay, thank you, Yao. So for me, I think a lot has been said here today. It is important that when we go back to our offices, we take some time to do some level of introspection, ask ourselves, how may we have contributed to get ourselves to where we are today? And then what are some of the measures we can put in place to move ourselves from here into a positive portfolio? We will have other sessions on the 24th and 26th where we can go into details on some of these measures we can put in place to improve our portfolios. Thank you very much.
Thank you. And Ziblim, finally, what do you want our people to take home today?
We should pay particular attention to our KYCs. Know your client. Know your client. If you know your client, build a good relationship. If you don't have a good relationship with your client, it's already a disaster for you. So follow your KYCs properly, know them, know their business, know that they are not engaged in any illegal kind of business that will deteriorate your portfolio tomorrow. Look at the seasonality, look at everything that pertains around the kind of business you finance, and develop a good relationship, organize workshops for your clients to educate them on your need and your requirements so that they are not left behind. You know what you are doing, your clients don't know what they are doing. And I will entreat you to join the other sessions that we're going to have on 24th and 26th so that you can get a more enhanced and better detailed information regarding this discussion. Thank you so much.
Thank you very much. So before I get to my participants for questions, please be reminded that on 24th, we'll deal with strategies for controlling delinquencies and managing delinquency crisis in small financial institutions. And then on 26th, we'll have another one, strategies for controlling delinquencies and managing delinquency crisis in larger financial institutions. So we'll have two different sessions, depending on where your strength lies, then you will join that one. And then the last one will be proactive strategies to prevent non-performing loans in the future. Of course, in June, we'll do a repeat of the gender finance that we did earlier on. So our participants, the floor is open. Those of you who have questions, you can raise your hands and then I'll call you and pick your questions. Or if you can also put it in the chat board, that's also recommended so that we can read it for you. I've seen one question. Okay, that's okay. So those of you who have your hands up, I saw David with your hand up. David from Mint Microfinance, if you can ask your question.
Oh,
Yes, David Bokwe. He can
Oh,
speak.
sorry.
He can
Yeah, David.
unmute himself and speak.
Yeah. David, please go ahead.
Kindly unmute, David. David, your microphone. Okay.
Sorry, I didn't have a question. It was an error. Sorry.
Okay. Okay. Any other person with a question or any clarification that you need to seek?
Okay, I've seen one question by John. He wanted to know, do guarantors also pay part in high MPL?
Okay.
Yes.
Mauna or Ziblim, can you take that for
Right.
us?
Okay, what's the name again? Samuel, correct?
John.
Okay, John. Yes. Guarantors play a role, not in high MPL, but in the performance. In the microfinance sector, we rely so much on guarantors. Why? Because we want somebody who can influence payment. So if you have a client who comes for a facility and the guarantor is a junior person to that person, to that client, for example, an elderly person go and bringing you somebody who has just finished school and started working, and because his salary is good, he brings a pay slip and say, this is my guarantor. The question you need to ask is, what is the influence of this guarantor on the client? If the guarantor has no impact in terms of influence, then it's as good as zero or good as nothing. So please, when financing or when lending, learn to get moral guarantors who can have an impact on the client to come and repay your facility rather than clients who have enough money, because most guarantors are not ready and willing to use their physical money to come and pay you off unless you go to the court and get a court judgment. If you don't have that space, then you better get a moral guarantor who can regulate or who can enhance your repayment in terms of the client repayment rather than just any guarantor. Thank you.
Thank you.
Yeah.
Yes.
This TK.
Yeah, TK.
Yes. I think that most of the questions that have come in the chat box are things that we will be dealing with in the next
Subsequent
webinar.
ones. Mm-hmm.
Yes, specifically dealing with delinquency, and also there is a component on the issues you need to look out for when you are dealing with a guarantor, because we take guarantors because we will want to make sure the person pays, and for that matter, we want to reduce the any incidents of non-payment. And so I think that during the next webinar, we will focus on those areas. Some have asked more of the analytical tools that are used. We have all of them as part of the next webinar. But the few one you can do is an in-house analytical tool that you use the data demographic and other information. You can also take a look at the credit scoring and also looking at the reference bureau. There are all these things that are built into the analytical tools. So I will encourage everyone who has attended this particular webinar to make it a point to attend the next webinar, where we go deeper into more practical issue of dealing with delinquency. Thank you very much.
Thank you, TK. I saw 2 hands up. Can you unmute and then ask your question, the first person?
Okay, I'm Naomi.
Naomi, from which institution?
We had microcredits.
Okay. Please go ahead.
Okay. I realize that from the discussion so far, a lot has to do with the policies and how the initial steps were not taken rightly. That is why we are having problems with our loans. I want to find out, as the association, apart from the seminars you hold and all that, do you actually come down to the level of the company to help them enact some of these policies? Because they may not know the right tools to use, even if you take maybe the credit policy, the operational policies and all that. I want to know how the association helps in enacting some of these policies to help the microfinance industry have right policies and strategies in place. Thank you.
Thank you very much. TK, would you want to respond to this?
Thank you very much. Yes, the association can only come into the institution when they are invited. And the associations are there to support its members. And so I will encourage all the institutions to utilize your associations where you need any support. Sometimes generally, you don't even need to reinvent the wheel. Sometimes it's about tweaking 1 or 2 areas, taking certain things, reviewing and all that, and you'll be there. And so we will encourage everyone here that where you lack any skill or competence or anything, reach out to the association for the necessary arrangements so that if they even know a particular consultant who can be of help to you, they can make the right recommendation to you. Thank you very much.
Thank you. Can we have the next question?
Okay, thank you. My name is Christy of DAD Microcredit Limited.
Okay, Christy,
Now,
go
mine
ahead.
is not a mine is not a question, but a contribution to what the astute panelists have exhausted. They have really done a good work to the topic. Congratulations. Now, what I want to add to what they have said in general has to do with institutions looking at the risk management of the institution and the entire portfolio. You realize that we have the traditional form of risk management and the ERM, that's the enterprise risk management. If institutions will actually deploy the enterprise risk management that looks at getting everybody on board to understand what risk is, because the sector is full of risks. I mean, the loans that we do, the lending that we do, it's almost 80% risk. And so if the institutions, the institutions are going to use the enterprise risk system, making sure that right from the cleaner down to the topmost person understand and apply the risk aspect that is needed at every level of the facility and the institution, it will help us, either than setting a risk department or a legal department and everything. They say that, oh, this one has to do with the risk department, so the risk people will handle it. But if I'm at the front desk and I understand the risks involved in whatever activity that has come to meet me, I will be able to deal with it because I understand it and not to move it to the next session. And with that, we mitigate the risks as much as possible and bring the portfolio to a better performance of the organization.
Thank you very much.
The second one I want to do, I think one of the things that we're going down to has to do with the business advisory services that we have to add as part of our work. When we are educating our clients, when we are helping them, when we are doing the KYCs and we are doing the appraisals, I think one of the things we can also chance on to advise them has to do with the business advisory services, which was also touched in a way with one of the panelists. I really loved that. And second, that we need to understand the businesses of our clients and advise wisely to help them and to help the institutions. Thank you.
Thank you very much.
Okay.
Yes.
To thank you so much, Madam. That's a very good observation and addition. Now, when it comes to enterprise risk management, now Central Bank, which is Bank of Ghana, has already initiated the steps to ensure that every bank, I'm sure it will come down to the microfinance as well. Every bank in the country now must have an enterprise risk management department that will ensure that they trickle down almost every information in terms of risk management to almost everybody they are dealing with. So it's becoming a requirement. And once it becomes a requirement, then we can rest assured that the banks will kind of implement this department or units to be able to see to the future that everybody understands risk and everybody understands risk management. So the microfinance will also be getting ready. I'm sure Bank of Ghana will be coming to you very soon on this. Thank you.
Thank you very much for the information. Any last two questions and then we can call it a day. If you have any burning question that you need to ask today, please do so.
Yeah. Hello, Mr. Janvi.
Yeah, Vincent, please go ahead.
Yeah, thank you very much. With the data you shared, is it mainly a microfinance company or which sector specific?
Microfinance and microcredit.
Okay. Is it possible, you said top 10 that are controlling the sector. Is it possible we can know these 10 top companies? If yes, that would be good. See people that we can talk to and also know our position in the industry to know how individual companies we can assess ourselves to see how we have controlled or the percentage of this and we have in the share.
So let's talk after the program. Eh?
Okay, all right. That would be good.
All right.
Thank you.
Any other question? Okay. I think all too soon we've come to the end of this conversation. Just as you are aware, the videos will be posted to all of you so that you can have a second look at it, listen to it again, take some crucial moments, listen to it and pick some resources out of it. And as you said, the other programs will also come through and subsequently that will be more targeted to address some of these issues. And so I will entreat you to make sure you register and join the various ones. And you also tell your colleagues to join, because this one, we don't take too much of your time, but we make sure we give you what is needed in the system. And so please discuss with your colleagues to also make sure they join in our subsequent webinars. So on this note, we'll call it a day, and thank you very much for making time to join us. Thank you, my panelists, for the serious contribution you've made to this program. I think without you, we wouldn't have gotten here. So we thank you very much, and thanks the institutions that participated very much. So on this note, see you in our next webinar. Thank you very much, and bye-bye.
Thank you.
Bye.
Thank you very much. Thank you, everyone.
Bye. Thank you. Bye. Bye.
Bye.